In other news, the European Central Bank has opted for a 50 base point rate hike, and President Lagarde stresses the ECB's intention to raise rates significantly at a steady pace going forward.
I hope the market will recover a bit. It seems like all the news has caused a bit of an overreaction, wouldn't you say?
Well, if that's the case, is there anything you can do to take advantage of the current state of things?
Upside is definitely limited in the short term due to the general financial environment. But also, if I'm wrong or over-optimistic and Ethereum continues to tank, I don't want to end up risking too much. What inexpensive options would you suggest?
I think you're probably going to want to look at your basic call and put spreads. Let's use a bullish call spread to benefit from a small bounce back in the market. If you buy a normal call, you benefit in one direction, but you have a set premium for the position, which also becomes your maximum loss in the worst case. To offset that to make the position less pricey, and when you feel like the movement is going to be limited, you can similarly limit your max profit by selling a call. The premium from the sold call offsets the premium to buy the initial call, making it easier for you to make an inexpensive bet on mild movements.
Ah, I see. So you're trading off upside potential to lower the premium cost. And if I felt like the market was going the other way, I could do the same with puts.
Yes, a bearish put would be where you'd buy a higher strike put than the one you sell.
So for my call spread, I'll set the expiry to December 30th. I can then buy 50 calls at the $1,175 strike, but sell 50 calls at the strike of $1,225, and that will cost me $1,000 for the position.
Let's see if the markets agree with you over the next few days.
Looks like I was right to an extent, and I profited too. The calls I bought netted me $25 a unit, which means I earned $1,250. Net profit after my premium comes to $250, which is still something.
Especially if you compare it to the overall market movement. $1,175 to $1,200 is about a 2% movement, but you still managed to earn a 25% profit from your initial premiums. Not bad.
I'm assuming I could construct the same thing using puts?
You could simply buy a put with a strike and sell a put at a higher strike price with the same expiration dates, of course. This should achieve the same goal as a bull call spread. Conversely, you can do a bear spread by buying one call and selling another call at a lower strike price. And that bear spread could benefit from a mild drop in underlying price before expiration.